Okay, good morning, guys. So we'll continue our discussions, and today we're going to talk about principles of internal control. So in the late 1990s and early 2000s, there were lots and lots of accounting-related frauds. A lot of court cases came about because of those situations. So the U.S. took a major step in legislating some of the internal controls, and they called that the Sarbanes-Oxley Act. Those are the two people who were members of their parliament and came through with that act. Canada has adopted a lot of those principles as far as the act is concerned, and of course a lot of the world has also gone about and legislated a lot of those materials. So some part of this discussion entails with what the legislation is. However, a majority entails with a good work ethic as far as accounting controls are concerned. So why do we need to control, or why do we need to have internal controls as far as accounting or money is concerned? Well, there are several reasons for that. First of all, we would like to make use of our resources in the best possible manner. And of course, the resources that we have are all your assets, all your equities, all your revenues. You would also, and of course your people, you would also want to prevent errors and irregularities. So errors do happen because they are people. We are all dealing with individuals, human beings. Everyone tends to make mistakes. So what happens is, if you have internal controls, chances of errors decrease quite a lot. You also would like to safeguard your assets as a company or as the owner of the company, because it is the assets that help you produce your revenues and make you stay in business. And of course, you want to maintain the accuracy and reliability of your accounting records. If someone is making use of those accounting records, financial statements, you would like to make them reliable and make sure that they're accurate. And one of the ways you can do that is through properly controlling the accounting information and how it gets to where it is. So how does all this work? Imagine an accounting department in a company, a small, large company, whatever you would like to imagine. If there was one person writing all the checks, I think there would be a lot more chances of fraud in that case. So that's why we tend to have different ways of preventing frauds. One of the ways is to have two different people sign off on a check, sign on a check before it gets released to a third party.
Oh yeah, thanks.
So some of the principles that we'll go through are as indicated throughout this presentation. The next slide deals with we'll go to the 5 principles of internal control. The first one is authorization of transactions and activities. So authorization by the proper individual is really, really critical. If you need to purchase an asset for the company, you will need to go through and ask for approval. You can't just go out there and purchase it and bring it and say, hey, I purchased this computer for $5,000. Yet the computer costs $1,000. Right? So you're trying to prevent fraud from happening. So you need authorization of proper individuals. Then you need segregation of duties. You would like 2 or 3 people to do different tasks as far as accounting is concerned. So if one person is responsible for purchasing, second person will be responsible for signing off on those purchases, a third person would be writing the checks, a fourth person would be making sure that the checks are cashed from the bank. So it's all about segregation of those duties. Documentation procedures. You must ensure that companies have the correct documents that they require. If you purchase a computer for the company, you must have the correct purchase orders, you must have the proper invoices and emails and backing your orders. Safeguards to control access and records. So basically, certain physical mechanical controls, passwords, cards, that you see in movies all the time, that certain things are kept locked up, and that's true. That's the way companies work. You need certain controls as far as physical controls are concerned. Lastly, you would need independent verification. This is key to having proper accounting and proper financial statements ready for all your users. So there would be two stages of verification. You've got internal verification and you've got external verification. Internal verification is done by internal auditors, and a lot of them are now certified. So they would have a designation called CIA, Certified Internal Auditors. And these are people responsible for making sure that all the controls are being followed, and that there's enough documentation in place, and that financial statements are actually reliable. Then you have external verification, and this is done by external accounting firms. This accounts for the fact that the company has now followed GAAP and they have followed internal control procedures. In each set of audited financial statements, the external auditor, always states that the internal controls are responsibility of the management of the company. So they are relying on the fact that internal controls exist. So internal auditors tend to focus on internal controls and how they are being processed and if everything is correct. External auditors tend to focus on financial statements and assume a lot of times that internal controls are being followed as far as they are concerned. Last slide just gives you a visual of segregation of duties. If one person is responsible for accounts receivable, for example, the other is responsible for accounts payable, and they all report to one person who is responsible for all your internal controls. So it's a matter of looking at it from that perspective. So this is it for today. Internal controls is a very brief topic. I just wanted to introduce you to this topic in this course. And of course your assignment now depends on how you can use these internal controls and how you can tell us what those companies did or did not do. So thank you for listening.